This is Mastering Your Wealth with David Gagnon, the podcast.
Now, RMDs, you may have heard them also called required minimum distributions, must be taken from your retirement accounts once you turn 73. That's the key age there, so that, of course, Uncle Sam, he gets his share of taxes. But is there leeway on when you must comply in that 73rd year for your first RMD? Well, here's Morningstar's Christine Benz.
So there's what's called a required beginning date, and this is actually April 1st of the year after the year in which you turn 73. So an example, say I turned 73 in 2024, I would have until April 1st of 2025 to take that first RMD. The tricky part about it is that April 1st RMD would be for 2024. I'd have to take another one by year end 2025 to account for my 2025 RMDs.
All right, so she's talking about April 1st of the year you turned 73. So keep that in mind here. And David, do you recommend the strategy that essentially results in, I guess, really a double tax bill for that first year?
You'll increase your income if you defer that first RMD payment to the next year, and then you got to take that year's payment out. Now, it depends on each person's situation. Now, we just finished up in the last quarter of last year. We track all our clients and who's required to take out these minimum distributions, who have satisfied them up to that point in time, and who needs to take out additional amount before the year ends. So it's something that we pay a lot of attention to, but we have to look at each person's situation. We had a number of folks last year turn 73. So what we did was we did an evaluation on, all right, where's your income level going to be for the current year of 2024 if you pulled it out then versus 2025. And we always want to see where are you going to pay the least amount of tax? What tax year should we pick up that first year distribution? Should we take it in that year of 2024 or push it off? It's a case-by-case evaluation to see where it's going to benefit you the most and pay the least amount of tax. But RMDs, it's a growing tax torpedo for some folks who did such a great job in accumulating so much money in their tax-deferred retirement accounts without looking into the future, with how that might look in their retirement. And that's where we open a lot of eyes when we evaluate the client's portfolio analysis looking into the future, because the sooner you see what might happen in the future with your RMDs and the painful tax costs that you're going to be exposed to and a higher tax rate on your other types of income, the sooner we can evaluate this, the better we can put together a forward-looking tax strategy with more tax-efficient solutions to address that. So, like I say, everybody's situation is different. It's got to be a personalized recommendation as to what they do with their RMD, especially in the first year.
So, David, for those that are wondering, okay, this whole RMD thing, I got to pay attention when I'm 73. Now I got this April 1st deadline to worry about and this whole double tax bill situation. How do I sit down with you and start creating a plan again so that, as you mentioned, you're having a tax plan that benefits me, but also I pay the least amount of taxes and Uncle Sam's out of my way? How do I do that with you?
Well, we have to take a high-level snapshot of what the future looks like with what you are putting your money into today from a tax perspective, and then we'll see what that RMD is going to look like in the year you have to take it out, and really what your needs call for income. Here's a good example of a client that I met with about 15 years ago. He was in his late 50s, had been working with an advisory firm for 28 years. And he had 7 figures in his qualified plans. I mean, a lot of money. And he never even heard of the term required minimum distributions. And he was working with this firm for 28 years. And so when I did his first analysis and I showed him what his RMDs were going to require that he had to disperse, and he had to take it out at 70 and a half. The rules were different. It was going to increase his income. He's going to have to take out more than $100,000 a year of what he planned to spend. Now think about that. You're going to add another $100,000 on top of what you really needed to live on. That puts you in a high tax bracket very early in your retirement, and his RMDs are much bigger today. And when I showed him that, he was just taken back, and he didn't realize what his tax nightmare was going to be. So what we did do is we restructured some of his qualified plan money, and we set up a tax efficient accumulation plan before he retired, which lessened the blow of his RMDs. But he had so much money in these qualified plans, it was hard to make a huge impact by addressing his restructuring of his tax strategy at that age, in that stage of his life. But a lot of people need to see this now before they retire so we can put together the right tax strategy so that with little pain to rebalance and rediversify your tax allocations, you can have big gains later, because time and money and making better financial decisions over a longer period of time will compound better results if you take advantage of good planning early. And so tax planning should be one of the big main discussions when people are working with advisors. But unfortunately, a lot of these financial services firms can't give you tax advice, and they're not licensed to give you tax advice. And then when you're told to go to your CPA or whoever does your taxes, they don't do real good forward-looking tax planning. They look at last year's tax return and what can they do as far as putting a Band-Aid on your tax bill by having you still maximum fund your qualified plans, not looking into the future with what that might do to your tax bill later.
You know, the days of sitting in Starbucks working or maybe people watching without buying anything, those days are over. The coffee chain is getting rid of its whole open door policy that allowed people to just kind of hang out and use the bathrooms and do whatever they want without a purchase. And some might balk at the new policy when they've been using all of this free access for so long. But it got me thinking here, what would you say to someone who's hesitant about advisor fees? Because they've relied on all this free access online, this whole do-it-yourself investing. So when it comes to sitting down with somebody like you, David, with over 3 decades of experience, I mean, you got to get paid at some point.
Yeah, you get what you pay for. You look at that in anything you put your money into. And when we do evaluations for folks that we're providing second opinions for, we always cover the cost versus the benefit. And this is the most important thing to look at. First of all, you need to know what your fees are, your costs that you're going to be spending your money on. But you have to look at, all right, if I'm paying a fee to an advisor, say it's higher than what you're doing in a no-load fund, what is that advisor creating in long-term value? And here's a great example. We were working on a portfolio analysis a few weeks ago, and what we showed folks, this couple, was that their risk level was extremely high for the amount of returns they were getting. And basically, when we showed them how to put together a strategic investment plan design that had airbags on their money and showed them how to take a lot less risk and actually significantly increase their yields net of our fees. So what we ended up doing was we lowered their risk by 54%, increased their yields by 44%, and that's after fees. So when you see that, they're paying probably a 1% higher fee than where they were, but we've reduced risk by 54%, increased their yields by 44%. I mean, that is life-changing in retirement if they're following an investment plan that gives them those benefits and results. And so you always, and the other thing is, we just talked about tax planning. Mm-hmm. And I have so many cases that we can refer to, but when we look at tax planning strategies and we looked into the future, and many of these folks were paying or going to pay 7 figures in taxes that we were able to mitigate and eliminate with a good forward-looking tax strategy. And, they paid a little bit of a fee to get our expertise and our guidance and our planning and advice to implement that and monitor it along the way. Would you pay a fee to save over $1 million in your lifetime in taxes? I mean, of course you would, right? Mm-hmm. You have to look at the value versus the cost. And I point this out. When people start staring and focusing on the fees, but then they forgot about the value that we're creating by implementing better decisions and strategies, then the light bulb finally goes off. You can be fee-focused, but you also got to be benefit and opportunity-focused on what that fee is going to create for you. So a good advisor should bring so much more value to your planning besides just focusing on that one investment or a couple of investments they sold you. Because I'll tell you, if they're not paying attention to helping you make good decisions in all the areas of financial planning needs, such as how do you optimize your Social Security so you don't make the costly mistakes that 95% of the people make. A lot of advisors don't give that advice because they don't understand Social Security. And the same thing with how do you maximize your pension that your employer is going to provide options for whether do you take the lump sum or the lifetime only. We show people how to get both and actually get more income lifetime and take control over the lump sum. Your income distribution plan. People don't get into the detail we get into with the income distribution plan or your estate plan or your health care plan strategy. So all these areas, people can make very costly mistakes, and they do. We see this over and over. And the problem is their advisors aren't aligned with comprehensive planning. Their focus is on that one investment or a couple of investments or their brokerage portfolio that they manage. And they're not getting that help in those other areas that can create a lot of financial benefits and opportunities. And they don't even know they're making these mistakes until we point this out.
You know, David, one of the confusing parts about getting ready for retirement is all the mixed messages that we hear in the media. You know, for example, there's a writer for Business Insider that posted a story saying that 2025 would see a third year in a row of 20% growth. Okay. And then that same writer in the same publication on the same day posted another story warning investors to brace themselves for a correction this year. So we got the left hand doesn't know what the right hand's doing kind of thing. It seems as though the reporter is trying to cover all of his bases here, and regardless of what happens. So it got me thinking about how you help clients find the balance between protection and growth and really kind of doing the same thing here. Talk to me about that.
We do things differently. We look for the investment tools that try to mitigate risk but still create the opportunity when the markets are favorable. And, you know, one of the areas, if somebody loves to be invested in the market, you know, we're using hedging strategies. We put airbags in the money, or what we call our buffers, right? So think about this. If the market is going to, what a buffer is going to do is protect you on the first portion of losses that the market might encounter. It could be 10 to 15%. So you have a hard buffer. You can't lose that money. If it goes below that, anything above that could be a loss. But you get the upside if it does well. And one of the things that we're trying to build in an investment plan is consistency. And consistency is going to be created by finding ways to lower that volatility factor so you don't get the big drops in your investment account and have more consistency in returns. And that means you're not trying to swing for the fences and find those home runs in your investment plan. If that's your investment approach, it's going to come back to burn you, and it's going to burn you bad at some point, and it's hard to recover. So what we're doing is we're looking at, first of all, your tolerance for risk. We're looking at your diversification, all your different asset allocation opportunities, but also the investment strategies. And being an independent, institutionalized platform of investment advisory advice, we have tools that people don't even know exist. And so when it comes to investment planning, if you can find a way to design an investment plan that's, first of all, aligned with your own personal goals and objectives, but we want to build consistency and lower that volatility and have more steady growth on the path forward. And you're going to build more wealth that way. You're going to be able to create more income when you find these intricate tools that we can put into a customized plan. And so, you know, there's speculation. There's always going to be speculation on the markets going up in the coming year or going down. And that's where people get so confused and they're not sure what to do. Well, if we have the tools that are able to give you the options of making money when the market's doing well and also protecting the money on the downside, now you don't have to do the guessing game or try to time the market, because that's never going to work out.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com.
Investment advisory services offered through Brookstone Wealth Advisors, LLC, BWA, a registered investment advisor and an affiliate of Brookstone Capital Management, LLC. BWA and First Financial Planners are independent of each other. Insurance products and services are not offered through BWA, but are offered and sold through individually licensed and appointed agents.
Information provided is not intended as tax or legal advice and should not be relied on as such. You are encouraged to seek tax or legal advice from an independent professional.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.
David Gagnon and First Financial Planners are not affiliated with nor endorsed by the Social Security Administration or any other government agency.
Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.